And the reason we're not seeing that is because something happened during the pandemic when inflation took over. Regulatory changes were put in place. The amount of regulation that was put in place artificially inflated energy costs that had nothing to do with the product itself. So when we were growing up, crude oil would account for 80% of the cost of a gallon of gasoline. Today, crude oil accounts for less than 50% of the cost of gasoline. The rest of it is accounted for in taxes, marketing and distribution, refining costs. All of those have been inflated in recent years because of regulation, because of inflation, because of the cost of energy to run electricity and being able to run those. And so right now, your bottom line on gasoline, if you paid nothing for crude oil, you would still be paying $1.60 per gallon for gasoline, paying nothing for the crude oil. So there is a limit to where we're at. And we're seeing that limit right now. You're seeing drilling counts beginning to drop. You're seeing production beginning to drop. You're seeing companies that Exxon came out and said that they're expecting a $1.5 billion hit in the second quarter because of the lower cost of crude oil. And so you're really seeing a dynamic that's taking place here where we're kind of at that threshold. You bring that down to the small business world here in Kansas, and we're predominantly stripper wells. That's a significant portion of our oil and gas production. Stripper wells account for 15% of the oil that is produced in the United States. That 15% is significant because it makes us the #1 producer of oil in the world. And so to lose that 15% would be disastrous for the United States.